Hi everyone, I'm Pia Arrieta, partner at Diana Morales Properties Knight Frank in Marbella. And today we're joined by Santiago Lapausa, who is an economist and tax advisor and partner at Javier Carrión Asesores since 2003. Santiago was recently at our office doing a presentation about the importance of getting tax advice before you even start looking at properties. So we thought it was great to bring him in today and do a video about this because we found it to be a very interesting topic. So thank you, Santiago, for being here with us today.
Thank you for the invitation.
Let's get straight to it. Why is it so important for buyers to look at tax advice and their tax situation before they even start looking at properties? What are the most common mistakes that they might find or would be able to avoid if they had a consultation with you, for example, about their tax situation?
Well, it's very important because buying a house in out of your country is an investment, and as any investment, you should have a strategy to do this investment, and that is a very important word: a strategy. To buy or to sell or to do any kind of investment without a strategy, you are completely blinded. So, and the tax planning is the tool to get to this strategy. A tax planning is a way to analyze the situation, the personal situation of a client, of the investor, and discover the weak points and the strength and the things that will help the investment to be safe from a tax point of view, because anything we do in life has a tax effect if there is any money involved, I mean. So the tax authorities are your partner, even if you don't know or you don't want, and in a very large stage. So if they are the partners, you must know how to deal with them. And they're going to claim their share at the right time.
Yes, that's always the case.
It's important, not very important, to have a tax review before you do anything, so you know where to go and have a strategy to follow.
Okay, no, definitely. And I think this applies not only to buyers, but also sometimes to sellers. We find situations where a seller, maybe of a certain age, is looking at selling their primary residence and then sort of puts the property in the market and then finds out that actually it was a better idea to wait until they're over 65, they've had the property as their permanent residence for, I think it's a minimum of 2 years, because obviously they can avoid paying capital gains tax. And that's something that not everyone knows. But in your case and the sort of the case studies that you gave us when you were at our office a few months ago, which we found very interesting, was mainly focused on giving us the examples for buyers, which were very interesting. And so what aspects of a buyer tax situation would you look at when you start analyzing the best strategy for them?
Because the clients here or the investors here are foreigners. It's not just a matter of looking at the local tax implication, but a cross-border tax planning. And that is probably the most common mistake that people do. Here as country of destiny, but also in the country of origin. Anything you must plan has to be analyzed according to the legislation of both jurisdictions that are going to be involved. So cross-border transactions needs cross-border advice. And there are many things that we have to look at. Depends on each client, each case. What is the purpose of the investment? Is it for long term, for short term? Where are you going to be living? Are you going to spend more time here in your country? Where is your family? Where are the funds? Are already in your name? Are in the name of a company? The value of the property is a substantial value, so you will be in one category of taxpayer or you will be under that category. So there are a lot of things that have to be analyzed, and many times the client who are considering, oh, I'm just buying a property or selling a property in Spain, So this is very local and must be analyzed very locally. And when you start talking to him or to her and realize what is the whole picture, they discover that they should have done things in the other country in a different way, because at the end, that what you do there, it can affect here. I give you an example. A British a man who is over 65, and so he wanted to retire and buy something here in Marbella. So he was planning to sell his house in the UK, which is tax-free there, because it was his permanent home. And also he wanted to sell his business in the UK, where he had a 25% tax relief in the UK, and was planning to buy something here in Spain. The tax period in the UK is different. It goes from April to April. Yes. In Spain, it goes from 1st of January to December. We have the natural year, the calendar year. In Spain, we don't have partial tax periods. If you move to Spain in March, so you're going to be resident since March till December, you are tax resident. But you are tax resident since January. We don't have partial years.
Even if you move in March, okay.
So wherever you have done since January, it affects to your Spanish tax year.
Is that whatever you have done even in another country?
Exactly. So this client is resident in the UK till April. So for UK is resident in according to their tax period, and then he moves to Spain. Wherever he does in that period, 1st of January, 1st of April, he may think, well, this is has nothing to do with Spain.
Yes, exactly.
But it has, because when he's resident in Spain,
it counts from the 1st of January. Okay.
So that's very important. So that this person was planning to do this, to sell his house in the UK and pay no taxes there, and to get a tax relief on the sale of the company and buy a house here. And he was planning to do all this at the beginning of the year. And he said, I was advised that if I come to Spain, the sale of the property in the UK, that is tax-free there, it will not be tax-free here because I'm no longer resident in the UK. And I said, well, this is wrong information, because you have, the key question is that you have a certain time of 2 years, you have a 2 years period to sell your property in Spain, the property that was your permanent home in the UK, to still benefit from the tax relief. But the key point here is that if he buys the house in Spain and moves to Spain in March or in April, he's going to be resident in Spain for the whole year. So if he sells the company, his business in the UK, he will pay taxes in Spain, because in Spain we don't have this 25% tax relief. So just waiting a few months and move to Spain after summer makes a difference for him.
Yeah.
And knowing that he has 2 years to sell his property in the UK to be tax-free here gives him peace of mind and a strategy. So now he knows that moving to Spain, he can buy the property now. He was planning to buy in February, March, buy in February or March, but do not become officially resident till July, just a few months. So then for 2025, for example, he is resident in the UK, not in Spain, so he paid taxes according to UK law.
Okay.
And makes a difference.
That's a huge difference, and I think something that's something that a lot of clients and also agents wouldn't know. That just a few months would make a huge difference.
I give you another example. A Serbian guy. He was planning to buy a big villa, more than 5 million euros. The money was. He had the money because he sold his property, his business, in Serbia. So the money was in his name. So the natural way is to buy in his name. But he was aware of the solidarity tax, the wealth tax, that applies to assets that are above 3 million euros. So he was, someone told him that maybe you can share the property with your wife and your children, so none of you are above this limit. But the money was in his name, so that means that he has to somehow do a donation to the wife, children, and so. Analyzing his situation, where the money is, the double tax treaty that applies to Serbia, we recommended him that you can buy with a company instead of buying in your personal name. The double tax treaty with Serbia and Spain does not give the right to Spain to tax on the wealth tax on companies. Most of the treaties says that if you own a company where more than 50% of the assets is Spanish real estate, then it's considered like a Spanish asset for wealth tax. But this double tax treaty said no, a Serbian company or a Spanish company is not subject to wealth tax. So he can buy the property with his own money without doing the split of transfer the money between spouses and things like that with a Spanish company and avoid the solidarity tax, the wealth tax. He was planning to use the property sometimes and the rest of the time trying to rent the property out. Serbia is not in Europe. So as a non-European tax citizen, if he buys the property in his name and rents it out, he's not allowed to deduct any cost and pay 24% taxes on gross income.
Yes.
With a company, the Spanish company is a Spanish taxpayer. So if the Spanish company is the one owning the property and renting it, it will pay taxes according to Spanish corporate income tax, deducting all the cost. So that's also another tick to the box. And at the time that this investor was buying, the Golden Visa program was still available. So one of the options to get this visa was investing 1 million euros in a company. So by creating the Spanish company, investing 1 million euros, he got the Golden Visa. So we do the tax planning according to the double tax treaty, the plan, where was the money, and he ended with a company that benefit for many, many things. He had the corporate structure and the strategy. And the fact is that he was not buying the property or any property at that time. He was just planning. So in 4 or 5 months ahead, with everything set up, he found the right property and purchased. So with the tax planning, he had a strategy. And then the real estate agent found the property according to the strategy, and the lawyer implemented the strategy. So he saved a lot of taxes just by doing this.
Fantastic. And I think it's very important for clients to go through this process before they even start looking at properties, because as you say, it's at the end of the day, it means that by the time they get to that stage with the real estate agency, all that part is completely prepared and ready to go. Then they can start looking at properties, see the one that they like, and then act more quickly, rather than encounter this issue when they've already seen a property they like, lose the time in getting all the planning in place, lose the property potentially, and then end up having to sort of start the searching process again. So I think it's, for all our viewers out there, I think it's very interesting and important that they get in touch with you.
It is, because not just at that stage that you say it is important to have that even before they go and see the property, so they can lose the property they want, because the market in Marbella is very, very fast. But they can even have already purchased the property. They have gone to the notary, they have gone to the lawyer, and then they go to the tax advisor and there's nothing we can
Yes,
do.
that's it. It's
Everything
too
is
late.
already done.
Yes,
You are the owner of the property.
Yes.
So yes, it's important to do this tax planning before you take any decision, and it's important that because this is there are three parts that must be connected: the real estate agent, the lawyer, and the tax advisor. The professionals have to know
definitely
what is the strategy.
Definitely, and it helps everyone. It makes it a much more seamless transaction, and at the end of the day, everyone has the client's best interest at heart. So definitely, these have been very interesting examples that you've given us. Do you have any other case studies that you could share?
Yeah, this is a very simple one, but the consequences are incredible.
Okay.
A French citizen who was 67. Okay. He has been living here in Spain for more than 10 years, permanently, enjoy life. And he was planning now, I'm going to sell my house and move back to France with my family. I want to be there at that time. He knew that when you are resident in Spain and you sell your main property, your main home, and you are over 65, you don't pay any taxes on the gain. It's tax-free.
Yes.
Even if you don't reinvest the money, it's tax-free. To qualify, you must have been living in that property for more than 3 years.
3 years.
Consecutively, as your permanent residency. He was living 10 years, and he was 67, so more than 65. Clearly tax-free. Even if he sells and gets 1 million euro or 10 million euros, tax-free. But the point was that his plan was to sell and move back to France. If he sells in March, for example, and moves to France, by the end of the year, it happens that he has spent less than 183 days in Spain. So for the entire year, he is non-resident. You see the point? He's been resident till the date of selling, March 2025. He sells, gets the money, thinks there's no tax I have to pay, and moves to France. So at the end of the year, he is not going to file a tax return in Spain as resident because he was not resident. That means that the rollover, the tax exemption for over 65 selling the main home does not apply. What
a surprise.
He loses this tax exemption. So let's see what happens. I am non-resident. What kind of tax situation do I face? Well, if you sell your main property and you move to another country and you reinvest in your new main property abroad, you can apply the exemption according to the money that you reinvest. But this person...
It wasn't the case, yeah.
He was not buying anything because he already had his property in France. He was selling, putting the money in the bank,
and that's it.
And go back to. So he didn't reinvest. The consequence is that he was thinking, I'm selling, paying no tax, and you pay all the tax.
You pay capital gains tax.
And that is, as a non-resident, is 19% on the profit. 1 million euros, profit, 19% tax. If he has been well advised, do not leave the country till after summer.
Okay.
Just a few months.
Yes, just a few months
makes a difference. If you leave the country in July, then you are still resident for the whole year because you have been living here more than 183 days.
Yeah.
Then
you're eligible for the tax
You're
exemption.
eligible for the tax system. It doesn't mean that you don't have to sell. You put the property on the market. Now you, the estate agent, knows the strategy. The lawyer knows the strategy, the client, we do. You find the client, okay, you want to buy the property, so that is the time where the lawyer implement the strategy, deals with the buyer, makes a contract, completion date, 1st of July. Do you agree? We agree. You're buying. You're not losing the client.
Yes.
But
it's a strategy to
completion
follow.
date is 1st of July. Very simple at the moment. It looks like, but you see, it's very easy. Let's say, by the consequence of just waiting a few months.
Yes.
So if the client do not take the tax advice, just go to the lawyer, just go to the estate agent, find a client, sells, moves back to France.
They would find themselves with a very unpleasant surprise.
I want to donate my money to my children. So maybe he has no money to pay this tax. And after 2 years or 3 years, he receives a letter, oh, you have to pay this tax.
You owe us 19% from your sale. Well, what an unpleasant surprise. Yeah.
Indeed.
No, it's really interesting. And we obviously, when you gave the presentation to our team a few months ago, we found out about all these case studies, which we found really interesting. And definitely it shows the importance of getting tax advice and doing some planning beforehand. Yeah, either buying or selling, definitely.
Buying, selling, and many other things, to be honest.
Of course.
Moving to Spain, you are here. You decide. Can I give you another example?
Of course, of course.
United Kingdom is very complex because they have a different kind of tax period, but also the legislation is different to Spain. No? Someone who is in the 60s wants to move to Spain, sorry. So he prepares everything in the UK with his lawyer, very expensive lawyer, to avoid inheritance tax there. So he set up a trust, put everything into a trust, and now he moves to Spain and say, well, that's fine, happy. But his daughter also lives in Spain, in Barcelona. Well, okay. He's the settler of the trust, and the beneficiary in case he passes away is the daughter.
Okay.
So according to the UK, it's fine. No tax, because in the UK, donation is tax-free, provided you survive for 7 years. So according to the UK law, perfect, he made a trust. What happened in Spain? Spain does not recognize trust. For Spain, trusts are transparent, and the settler remains the legal owner. And so if this person dies, the beneficiary, the daughter, is resident in Spain and lives in Barcelona. So inheritance tax applies according to Spanish law and the law in Barcelona,
region,
in Catalonia.
Yes. Yeah.
So if the trust is not recognized in Spain, the daughter, by the death of the father, is receiving all the assets that are underlying the trust. So she's fully taxed in Spain. The whole thing that he made in the UK is not valid in Spain. And the law in Barcelona for inheritance tax is not like the one we have here or in Madrid. It's much tougher. So it doesn't matter how much he paid to the very, very good lawyer in the UK. You have to do cross-border tax planning, not just focus on where I am, or if you are here buying, focus on what I'm buying. You have to do the whole thing.
Of course. Wow. Well, yeah.
And this client maybe was not thinking that what I did in the UK is not your business. You don't have to look at that. Yes. It's been well checked there. No. You have to tell me that I will tell you if it's important or not.
Yeah, definitely. No, another example that goes to show the importance of tax planning. Well, thank you very much, Santiago.
Thank you. Thanks for the invitation.
Yes, our pleasure. And if anyone has any questions regarding tax advice and planning, please get in touch with Santiago Lapausa from Javier Carrión Asesores, or contact us and we'll gladly give you their contact details. So thank you very much, Santiago.
Thank you.